Hi folks, David Waring here again with InformedTrades.com and today's lesson of the day. In our last lesson we continued our discussion of trading stocks on margin with a look at the difference between initial and maintenance margin. In today's lesson we're going to continue our free stock trading course with a look at how to calculate your margin levels on the Thinkorswim platform. So let's get started.
Okay, to make the math a little easier on us here, instead of logging into my paper trading account, I've taken screenshots for us to work off of. The reason I say this will make the math a little easier for us is because this will keep the market fluctuations from changing our numbers as we go through the math of calculating effects on buying power. For those of you who would like to practice placing some margin trades on the Thinkorswim platform, I've included a link where you can register for a free paper trading account above this video if you've not done so already. Okay, so the first example we are going to look at is trading a long position on margin. For this example, as you can see in the screenshot I'm displaying now, I'm long 450 shares of Google, which had a current market price of $337 when I took this screenshot. This means that the dollar value of this position as displayed on the platform is $650. As you can also see, the cash balance of my account is $98,954.75. So it is obvious here that without the use of margin, I would not have been able to purchase this position. Next, let's take a look at how the math flows through my account here. As we learned about in our earlier lessons, I'm required to put up at least 50% of the purchase price of the stock when trading on margin to initiate a new position. As this position cost me $151,650, this means that I'm required to put up at least half that amount, which comes out to $75,825. Now, normally on the Thinkorswim platform, I would be required to have only 30% of the current market price as my maintenance margin, as they require a small amount higher in maintenance margin than is required by regulations. Because of the recent market volatility, however, the stocks that I am using in this example are required to be carried at 50% maintenance margin as well, which leaves me with the cash balance of my account, $98,954.75, minus my maintenance margin requirement, which is $75,825, which gives me $23,129.75 in cash available to take new positions, which is left in my account. So, sorry for the confusion here on the initial and maintenance margin being the same thing, as normally they are different, but recent market volatility has changed things a little bit for this example. Okay. All of the information shows up in the Accounts tab of the Thinkorswim platform and fluctuates with the market in real time. So basically here, as long as my buying power remains above zero, then I can initiate new positions and I do not have to put up additional funds or sell securities to meet a margin call. Next, let's take a look at a short stock example. The first thing to understand about shorting stocks is that a margin account is required to do so because in a short sale you are borrowing stock from someone else and selling it in the open market. The second thing that is important to understand is that when you sell a stock short, the proceeds from the short sale are deposited into your account, which increases your cash balance. Because of this, the margin requirement for short selling is 150% initial margin and 130% margin on the Thinkorswim platform when shorting stocks under normal market conditions. Because the short sale increases the cash in your account by 100% of the sale price of the stock, however, the amount of a trader's account that he or she must put up in cash remains 50% initiation and 30% maintenance just as in the long stock example. In other words, because they're able to use the stock, the money from the stock that they've just sold, it doesn't actually increase the margin requirements by 100%. For our short sale example, I'm going to sell 5,000 shares of Microsoft stock, which at the time I took this screenshot had a market price of $21.22. As shown on the platform, this makes the dollar value of this position $106,100. Since I sold this stock short, the $106,100 proceeds from the sale are deposited into my account, bringing the balance of the account to the cash amount of $97,105.50 plus $106,100, which equals $203,205.50. Because of the recent market volatility here again, both the initial and the maintenance margin are 150% for this stock, which equals 106,000 times 1.5, or $159,150. To get the cash amount available to initiate new positions, I simply subtract the $159,150 from the $203,205.50 balance of my account, which gives me $44,055.50. That's our lesson for today, and that wraps up our series of lessons on trading stocks on margin. In our next lesson, we're going to wrap up our module on the rules and regulations surrounding trading stocks with a look at something which is known as the pattern day trading rule. So I hope to see you then. As always, if there are any questions or comments, please feel free to leave them in the comments section below, and good luck with your trading.